Pull $30,000 out of your traditional IRA this year, and the IRS may make roughly $19,600 of your Social Security benefit taxable right alongside it. Not the IRA dollar. Your Social Security. Not because you did something wrong, because of a rule that most retirees have never heard of, and that your own advisor may not have brought up. That rule is called provisional income, and I want to show you how it works, because the version of this that catches most people is not a one-time mistake. It is a pattern that starts the year they stop working and can lock you into a higher-than-necessary tax bill for the rest of your retirement. I am your guide to one retirement decision at a time on this channel, the decisions most advisors rush past. And today, that decision is this: why your IRA may be quietly setting up your Social Security to be taxed, and what to do about it before your required minimum distribution age arrives. In the next 16 minutes, we will cover 5 things. First, how provisional income works, and why a pre-tax IRA dollar raises your effective tax bill more than an ordinary dollar alone. Second, the RMD clock and what it does when it goes off. Third, the low tax window most retirees are sitting inside right now and do not know it. Fourth, 4 legal tools that cut provisional income before the deadline, including one that can satisfy your RMD without raising your provisional income at all. Fifth, the one number you should write down today. Let me show you the math, step by step. Part 1. The provisional income trap, and why IRA dollars hit you twice. The IRS uses a number called provisional income to decide whether your Social Security benefit gets taxed and how much of it gets taxed. Here is the formula. Take your adjusted gross income. Add any tax-exempt interest you received. Yes, even municipal bond income counts here. Then add half of your annual Social Security benefit. If that number stays low enough, your Social Security is completely tax-free. But once it crosses certain thresholds, the IRS starts including a portion of your benefit in your taxable income. For a married couple filing jointly, the first threshold is $32,000. Above that, up to 50% of your Social Security benefit becomes taxable. Cross the second threshold at $44,000, and up to 85% of your benefit is taxable. Those thresholds are not indexed for inflation. Congress set the first one back in 1983 and added the second in 1993, and has never raised either since. So every year, more retirees drift over them simply because their income keeps up with the cost of living, and the thresholds do not move at all. For a single filer, the thresholds are tighter. 25,000 triggers the 50% zone, and 34,000 sends 85% of your benefit into taxable income. Now here is what makes IRA withdrawals so dangerous in this picture. Every dollar you pull from a traditional IRA, assuming it is pre-tax money, counts in your adjusted gross income in full. 100 cents on the dollar. And because it raises your adjusted gross income, it also raises your provisional income, which can then flip a portion of your Social Security from tax-free to taxable. So you are not just paying income tax on the IRA dollar you pulled out. You're also generating new tax on Social Security income you were already planning to spend. Some tax experts call this the tax torpedo. Each pre-tax IRA dollar you withdraw can generate more than $1 of taxable income in the same year, because it does double duty. It hits adjusted gross income directly, and it pulls more of your Social Security into the taxable column at the same time. Run the numbers on the scenario I described. You collect $24,000 a year in Social Security. You have $18,000 coming in from a pension. Before the IRA withdrawal, your provisional income is $30,000, just below the $32,000 threshold. Now you pull $30,000 from your IRA. Your provisional income jumps to $60,000, well past the $44,000 second threshold. Under the IRS phase-in formula, roughly $19,600 of your $24,000 Social Security benefit now becomes includable in your gross income. The $30,000 IRA withdrawal did not just add $30,000 to your gross income. It dragged nearly $19,600 of Social Security income into taxable territory right along with it. And it does not stop there. A higher modified adjusted gross income can also raise your Medicare premiums. Once your income crosses certain thresholds, Medicare adds a surcharge called IRMA to your Part B and Part D premiums. Medicare looks at your income from 2 years earlier. So a large IRA withdrawal this year can show up as a surprise premium increase 2 years from now, a hit most retirees never see coming. For 2026, if your modified adjusted gross income crosses $109,000 as a single filer, or $218,000 as a married couple filing jointly, your standard Part B premium jumps from $202.90 a month to $284.10. That is about $81 more every month, roughly $975 a year per person, and a Part D surcharge stacks on top of that. At the highest income levels, the Part B premium more than triples. So before any large withdrawal decision, check the current IRMA brackets at Medicare.gov. Part 2. The RMD clock. What happens at your RMD age if you do nothing? Required minimum distributions are the government's way of collecting on the tax it deferred for decades. When you put money into a traditional IRA or a 401k, you got a tax deduction going in. That money grew without being taxed each year. But the deal has always had a deadline, starting at age 73 for those born between 1951 and 1959, or at age 75 for those born in 1960 or after, under the Secure 2.0 Act. You're required to start withdrawing a minimum amount every single year, whether you need the money or not. The RMD formula uses the prior year-end balance of your account and a life expectancy factor from IRS tables. At age 73, the required distribution on a $500,000 IRA runs around 4% or so of the balance. On a $1 million IRA, the first required withdrawal runs about $37,700 per year, roughly 4%, mandatory. And because those forced withdrawals run straight through your taxable income and your provisional income formula, they can lock 85% of your Social Security into a taxable status every year from that point forward. Here is what makes this so frustrating. You saved that money over 40 years. You followed the rules. You got the deduction when the government said, take it. And now, the year you hit your RMD age, the government sends you a forced income event you did not choose, in an amount you did not plan for, that reclassifies income you were already counting on. Fail to take your required minimum distribution in full, and the penalty is not minor. The IRS charges a 25% excise tax on the amount you missed, reduced to 10% if you correct it within a 2-year window. The trap is the size of the IRA balance you carry into that deadline. The bigger the balance, the bigger the forced withdrawal. The bigger the withdrawal, the harder it hits provisional income. The harder it hits provisional income, the more of your Social Security gets taxed. And this is not a one-time event. It repeats every year with a required withdrawal percentage that rises as you age for as long as you live. Part 3. The low tax window, and why it is open right now. Here is the part almost nobody talks about. Between the year you retire and the year your required minimum distributions begin, at 73 or 75, depending on your birth year. Most people are sitting in the lowest tax environment of their adult lives. Their paycheck stopped. Social Security may not have started yet, or just started. RMDs have not kicked in. The tax brackets that have been shrinking their savings for decades suddenly have room in them. This is the window, and it closes at your RMD age. Think about how that window looks in practice. You are 67. You have a $700,000 traditional IRA. Your Social Security, $24,000 a year, just started. You have $18,000 coming in from a small pension. Run the provisional income formula. Provisional income is $30,000. That is below the $32,000 threshold for joint filers, which means none of your Social Security is federally taxable at this point. Your adjusted gross income is just the $18,000 pension. After the 2026 married standard deduction of $32,200, your federal taxable income is effectively zero. Now look at the distance from where you are. Zero or near zero federal taxable income to the top of the 12% bracket. That entire corridor is available. Every dollar of IRA you convert or draw down in that space is taxed at 10 or 12%, instead of the higher rate it could face at your RMD age. The 12% bracket tops at about $100,800 of taxable income for a married couple in 2026. Keep in mind, if you convert enough to push your provisional income past $32,000, some of your Social Security will start becoming taxable too, which is why sizing the conversion carefully each year matters. The question every retiree in that window should be asking is, would I rather pay taxes on this IRA money today at my current rate, while I control the timing and the amount? Or would I rather let the government control the timing starting at my RMD age when it forces a larger withdrawal at a potentially higher rate? Part 4. 4 tools to cut provisional income before the clock runs out. This is the section I promised you. 4 strategies that let you move from the government's timing to your own, including Tool 3 on this list, Qualified Charitable Distributions, which can satisfy your required minimum distribution for the year without raising your provisional income at all. Tool 1. Roth conversions in the low-tax window. A Roth conversion means you move a portion of your traditional IRA into a Roth IRA. You pay ordinary income taxes on the amount you convert in the year of the conversion. But money that sits inside a Roth IRA grows tax-free, and qualified distributions from a Roth IRA are tax-free and do not count toward your adjusted gross income. They do not raise your provisional income. They do not trigger extra taxation of your Social Security. And, critically, Roth IRAs have no required minimum distribution requirement during your lifetime. The strategy is called conversion pacing. You convert only enough each year to fill the headroom in your current tax bracket without pushing yourself into a higher one. If you're in the 12% bracket, for a married couple in 2026, that bracket tops at about $100,800 of taxable income, and your current taxable income is $60,000, you have roughly $40,000 of room. Converting $30,000 to $40,000 per year lets you prepay a predictable tax at a known rate instead of rolling the dice on what the rate and the RMD amount will be 8 years from now. One important note: each conversion dollar also flows through your provisional income formula, which means a conversion that pushes you past the Social Security threshold can make more of your benefit taxable too, using up bracket room faster than the conversion amount alone. A conversion that is oversized can push you over an IRA threshold and cost you more in Medicare premiums than the conversion saves. Size it carefully and run the numbers for your specific situation. Tool 2. Spend from the IRA now, on your own terms. If Roth conversions feel complex, the simpler version of the same idea is this. Live on your IRA money in your early retirement years instead of treating it as untouchable savings. Take a calculated draw each year, perhaps the amount that fills your current bracket without going over. You pay the tax now at the current rate. You reduce the future RMD base. You're still paying tax. You're just choosing when, at what rate, and in what amount, rather than letting the IRS choose for you. Tool 3. Qualified Charitable Distributions. If you're 70 and a half or older and you give to charity, this is one of the most underused tools in retirement tax planning. A Qualified Charitable Distribution, a QCD, is a direct transfer from your traditional IRA to a qualified charity. The money goes straight from the IRA to the organization. It never passes through your hands. It is excluded from your gross income entirely. It never shows up in your adjusted gross income. It never enters the provisional income formula, and it counts towards satisfying your required minimum distribution for the year. The annual limit per person is $111,000 in 2026, indexed for inflation per IRS notice 2025-67. So a married couple can direct up to $222,000 per year out of their IRAs to charity. For retirees who are going to donate anyway, the QCD is not just a charitable strategy. It is a precision instrument for managing provisional income at virtually no after-tax cost. One timing note. QCD eligibility begins at age 70 and a half. The money must transfer directly from the IRA trustee to the charity. Never withdraw it yourself first. Tool 4. Right-sizing the IRA balance before your RMD deadline. The deeper version of this whole strategy is a concept sometimes called the ideal tax-deferred balance. The goal is to arrive at your RMD age with a traditional IRA balance that is large enough to generate RMDs that absorb your standard deduction, but not so large that those RMDs push you well into taxable territory. For a married couple filing jointly in 2026, the standard deduction is $32,200. Using the IRS Uniform Lifetime Table Factor of 26.5 for age 73, an IRA balance of roughly $850,000 would generate a first-year RMD of about $32,000, right around the basic standard deduction. If your only taxable income were that RMD, your federal income tax bill could approach zero. The principle holds. There is a target IRA balance that lets you take your forced distributions at the lowest effective rate. The question is not how to get to zero. The question is, which dollar costs you the least when the government forces you to pull it out? Getting to the right balance is the job of the years between now and your RMD deadline. Part 5. The one number to write down today. Pull up your most recent IRA and 401k statements and add up the total balance across all your tax-deferred retirement accounts. Write that number down. Now ask yourself, at my current balance and growth rate, what will my required minimum distribution be when I reach my RMD age? Divide your current balance by 26.5, which is the IRS Uniform Lifetime Table Factor for age 73. Then add that to your expected Social Security income for the same year, plus any pension or other income you will have. Run the provisional income formula, adjusted gross income plus half of Social Security. Where does that land relative to the $32,000 and $44,000 thresholds for joint filers? If your projected provisional income at your RMD age is going to land well above the $44,000 threshold with no action taken, you have time to do something about it, but only if you start now. Roth conversions, strategic IRA draws, and Qualified Charitable Distributions all take years of consistent execution to meaningfully move the needle on a large IRA balance. Waiting until 1 or 2 years before your RMD age to start is better than not starting at all. Starting at 63 or 65 is better still. Here is the one thing I want you to carry out of this video. The question is not, how do I avoid paying taxes on my IRA? You cannot avoid taxes on a traditional IRA forever. The real question is, at what rate, when, and on whose schedule? Right now, before your RMD age, you may be sitting in the lowest tax environment you will see for the rest of your retirement. The window to pay those taxes on your own terms and protect the Social Security income you spent a lifetime earning may be open for a few more years. The trap does not spring at your RMD age by surprise. It springs because nobody ran the numbers 10 years earlier. If you are in or near retirement with a meaningful IRA balance, do these 2 things before the week is out. Run the provisional income estimate I described in Part 5. It takes 10 minutes and a calculator. And if the number you get concerns you, bring it to a fee-only, fiduciary advisor who can help you design a conversion pace that fits your specific bracket and your Medicare situation. Ask any advisor how they are compensated and whether they are acting as a fiduciary for your retirement tax planning before you take their advice. This video is education, not financial advice. The numbers here are illustrative. Your actual tax situation depends on your full income picture, filing status, state of residence, and the specific rules in effect for your tax year. Run your situation with a qualified professional before making any moves. If this is the first time someone has explained the provisional income formula in plain English, and it landed, type the word torpedo in the comments. Hit the like button before you go. 2 seconds. It helps others your age find this content at the moment they need it most. If you are not subscribed yet, this channel covers one retirement decision at a time. Social Security, taxes, withdrawal order, Medicare, real numbers, no sales pitch. Hit subscribe so you do not miss the next one. The money you built over 40 years does not stop working for you when you retire, but neither does the tax code. The retirees who come out ahead are the ones who understood the rules before the deadline arrived. I will see you in the next one.